Okay, let's get straight into it. We're looking at the financial markets closing out Friday, May 16th, 2025, Eastern Time. And, well, the big picture today, drawing on insights from Preeti Capital, seems to be this real
A
contrast.
contrast. How so?
Well, you've got this strong performance, this real upward pull in the tech sector, lots of investor confidence there. Think AI, innovation, some decent earnings too.
Right, the familiar tech optimism.
Exactly. But then layered underneath, there's this distinct note of caution, linked to those ongoing global uncertainties.
Ah, the geopolitical stuff. Eastern Europe, South China Sea.
Yeah, precisely.
Right.
And that seems to be putting a bit of a drag on things like commodities, currencies, too. So our mission today is really to unpack these mixed signals for you.
Makes sense. To sort of dig into the key movements across the different market segments and figure out what they might actually be telling us.
Exactly. It's about making sense of that tension between the tech enthusiasm and the broader anxieties.
Yeah, that contrast is crucial. It really shows how the market is always trying to balance, future potential against present-day worries. It's not just numbers, it reflects everything going on.
Okay, so let's start unpacking it with the major US indices. Kind of a split picture here. The S&P 500, it managed to gain up 0.41%.
Huh?
And the Dow Jones did even better, up 0.65%. Solid gain there.
Right, the blue chip's doing well.
But then the Nasdaq actually dipped slightly, down 0.18%. Meanwhile, the Russell 2000, tracking the smaller companies, that was up 0.52%.
Hmm. Yeah, that divergence between the Dow and Nasdaq is interesting, isn't it?
What do you make of that?
Well, it could suggest different strategies at play. Strength in the Dow, those
Yeah.
big established companies, might mean investors are looking for, well, perceived stability perhaps, given those global jitters.
Seeking safer ground, maybe?
Could be.
Yeah.
Maybe leaning into dividend payers, more established names. But the Nasdaq's slight pullback, even with all the positive tech talk, maybe some profit taking after recent run-up.
Or sensitivity to interest rate talk.
That too, yeah. But the Russell 2000 gaining, that's often seen as a positive sign for the broader domestic economy. Confidence in smaller, U.S.-focused firms.
And then there's the VIX, the CBOE Volatility Index, the so-called fear gauge. That actually dropped down over 1.2%.
Right, so even with those background worries, the immediate market fear, or perceived risk anyway, seems to have eased a bit.
Less panic, maybe.
Yeah, maybe investors are getting a bit more used to the current global situation, or perhaps it's just a temporary calm. Definitely one to watch.
Okay, let's hop over to Europe. The FTSE 100 in London up a respectable 0.36%. And the German DAX, even stronger, up 0.73%.
Hmm. Positive signs there. Suggests some underlying strength, or at least in certain sectors within those European economies.
What could be driving Germany, for example?
Well, the DAX often reflects manufacturing, industrial strength, could be
Mhm.
good export demand, strong corporate earnings, maybe a bit of both. And the FTSE's gain shows some confidence in the UK market, too. Different drivers in each region, of course.
Right. Now, shifting over to Asia, the picture looks, well, a bit more muted.
Okay.
Japan's Nikkei 225 was basically flat. The Hang Seng in Hong Kong down 0.46%, and the Shanghai Composite also slipped, down 0.40%.
Yeah, that more subdued performance in Asia often reflects a mix of things. Regional economic uncertainties, maybe a more direct hit from those global geopolitical issues we talked about.
Trade dynamics, perhaps?
Could be part of it too.
Yeah.
Each market there has its own unique economic and political context, so they won't always mirror the West.
Okay, let's pivot to the bond market. We're seeing yields dropping pretty much across the board here.
Oh, interesting. What are the numbers?
The 10-year Treasury yield down quite a bit, about 1.61%, sitting at
Quite
4.455%.
significant move.
And the 13-week T-bill yield also down 0.63% to 4.258%. Even the long end, the 30-year bond yield, dropped nearly a full percent, down to 4.918%.
Wow, okay. That widespread decline in yields is usually a pretty strong signal.
Damn.
It typically signals increased demand for safe haven assets, U.S. government bonds.
Mm.
Investors tend to flock there when they're worried about the economy, maybe inflation, maybe growth prospects.
So more caution.
Generally, yes. The fact that even longer-term yields are falling suggests these might not just be short-term jitters. Could be a more cautious outlook on future growth.
So for you, the listener, what are the practical implications when these long-term yields fall?
Well, the most direct impact is usually on borrowing costs. Lower Treasury yields often translate into lower interest rates for things like mortgages, corporate loans.
Cheaper to borrow then?
Potentially, yes, which could encourage economic activity. But, it's also a sign investors might prefer the safety of bonds over riskier things like stocks, kind of a double-edged sword.
Right. Okay, let's switch gears to currencies. The US dollar index took a small step back, down about 0.19% to 100.688, a slight weakening.
Hmm. What might be behind that?
Could be lots of things, really. Reaction to US economic data, maybe changing expectations about what the Fed might do next with rates, or simply other currencies gaining a bit. It's all relative.
True. And what about those other currencies?
Well, the euro saw a small gain against the dollar, up about 0.1% to 1.1203. The British pound also edged up just slightly,
Okay.
but the Japanese yen weakened. It fell about 0.21% against the dollar to 145.307.
Yeah, these little shifts really highlight how interconnected everything is.
Mm-hmm.
The euro gaining might reflect some positive news or sentiment in the eurozone. Same for the pound in the UK.
And the yen weakening.
That could be tied to Japan's own economic situation, maybe monetary policy differences, or just the relative appeal of holding other currencies right now. It's a constant global balancing act.
Okay, now let's check in on commodities. Looks like a generally downward trend here today.
Interesting. What are we seeing?
Gold dipped slightly, about 0.5% down. Silver saw a bit more of a drop, nearly 1%.
Okay, precious metals mostly lower.
Even oil prices were slightly down, both U.S. crude and the international benchmark. Just minor declines. Natural gas down about 0.5% too.
So a general softness in commodities. What does that usually suggest? Well, often a broad downward trend like that, maybe except for gold, which can still act as a bit of a hedge, suggests potential concerns about future global economic growth. Less growth means less demand for raw materials and energy.
So softer energy prices might mean expectations of slower economic activity.
That's often the interpretation, yes. If the economy slows, you typically use less energy.
But the one that really jumped out was copper, down almost 1.7%. That seems pretty significant.
Ooh, yeah, that is significant. Copper's often called Dr. Copper because it's seen as having a PhD in economics,
Because it's used in so many industries.
Exactly, construction, manufacturing, everything. So a sharp drop like that can definitely signal worries about global industrial demand, maybe potential slowdowns brewing. It's a key economic barometer.
Right. Makes sense. Okay, turning to exchange-traded funds, ETFs. A real mix here today.
Okay, how so?
Broader market ETFs were up about 0.5%. Tech had a small gain, 0.14%, but financials up 0.67%, and healthcare really strong, up 1.31%.
Wow, healthcare leading the way there.
Yeah. Energy also slightly, small caps up too, about 0.65%. But here's the contrast. Innovation ETFs got hit pretty hard, down 1.44%.
Okay. That mix really highlights a potential shift in where investors are putting their money, doesn't it?
What do you read into that?
Well, the strength in financials could be tied to the interest rate environment. Higher rates often help banks' margins, healthcare strength. That's often seen as more defensive, right?
Right.
Less tied to the economic cycle.
So a flight to safety, perhaps, within equities?
Could be part of it. And the weakness in those innovation ETFs maybe suggests a cooling off towards higher growth, maybe more speculative stocks, especially with market uncertainty and rate discussions.
A move towards value or established sectors?
Possibly. It points towards investors maybe becoming a bit more selective, favoring stability, perhaps?
Okay, and let's drill down into some individual stocks. We saw some big gainers. Deere & Company up 3.78%. NextEra Energy up 3.27%.
Strong moves.
Also, Coca-Cola up 3.54%, General Electric 2.75%, Procter & Gamble 2.78%, and Pfizer up 2.63%.
Quite a diverse group of winners there. Any thoughts on why?
Well, you could guess, right? Deere maybe points to strength in agriculture. NextEra, that fits the renewable energy theme.
Right, and Coke and P&G are classic consumer staples, seen as reliable in uncertain times.
Exactly. GE could be positive news from its divisions, aviation or energy. And Pfizer, maybe pipeline news or just broader healthcare strength.
Makes sense. Specific stories driving individual performance.
But on the other side of the coin, United Health Group took a massive hit, down almost 11%.
Ouch. Yeah, nearly 11%. That's huge for a company that size.
What could cause such a big drop?
Often, a move like that points to something pretty significant. Maybe regulatory concerns swirling around the healthcare industry, policy changes being talked about, or maybe some specific negative news about the company itself. That definitely warrants a closer look.
We also saw some notable tech names down. Oracle off 2.18%, Apple down 0.41%, NVIDIA slipped 0.38%, Tesla down 1.40%.
So reinforcing that mixed tech picture.
But then you had modest gains for financials like Goldman Sachs and JP Morgan, both up around 0.7%. And BlackRock had a good day, up 1.66%.
Yeah, that really underlines that potential sector rotation we were just talking about. Some profit-taking or caution in big tech names, while financials are seeing buying interest.
It suggests investors are maybe reassessing those high-tech valuations while seeing opportunity in the financial sector, maybe benefiting from rate dynamics or market activity.
Precisely.
Okay, let's zoom back into that tech sector for a final look. We said it was mostly down overall. Besides those big names, semis like AMD were down.
Right, around 2.3% for AMD.
Alphabet, Google's parent, down about 0.85%. Amazon down roughly 2.4%.
So weakness in chips, search, e-commerce.
Microsoft held up, actually gained a little, 0.23%, and Snowflake was up 0.84%. Zoom Video up 0.70%.
Ah, okay. So definitely not monolithic. Resilience in some areas, like maybe enterprise software, cloud.
While others like Meta, Facebook's parent, were down more significantly, about 2.35%, and Roku down 2.5%.
Yeah, it really shows investors being selective within tech. The broad optimism is still there, maybe, but the actual trading shows caution. Concerns about chip demand, maybe platform growth rates.
But still finding opportunities in specific niches.
Exactly. Cloud, enterprise software, communication tools like Zoom and Snowflake seem to be holding up better or even gaining. It shows the tech sector has many different parts, facing different pressures and opportunities.
So wrapping it all up, it really feels like today was defined by that push and pull. You've got the optimism, especially around certain tech themes, but it's bumping up against these significant global worries.
Absolutely. And we see that reflected in all these nuanced moves across stocks, bonds, currencies, commodities, ETFs. It's rarely a straight line up or down for everything.
It's a complex interplay, isn't it? Economic data, investor mood, those big global events.
Definitely. Understanding how these pieces fit together across the whole market picture is so important right now for anyone navigating this environment.
And that leads us to a final thought for you, our listener. Given everything we've discussed today, this tension between tech's promise and the world's anxieties, where do you see the biggest opportunities emerging? Or perhaps, where do you see the most significant risks in the near future?
Yeah, think about it. How might that interplay between innovation and global stability or instability shape the market next?
Yep.
What's your reasoning? Something to mull over.